Well, good morning, good afternoon, or good evening, depending on where in the world you're catching us from. It's great to have all of you here. Welcome to this presentation on high probability forex trading. So once again, I'm Adam Khoo, and I believe you're listening to this because you want to create another source of income for yourself, trading the financial markets. Whether you're a beginner, you have never traded before, whether you've been trading for some time and you're struggling to be consistently profitable, I'll share with you exactly what it takes and what you can do to achieve a more sustainable source of income for yourself as a trader. So I hope to be able to create a lot of value for you guys this morning, afternoon, evening. A bit about myself. I started trading at the age of 17. I've been trading for the last 28 years, so you can kind of like guess my age. Started trading equities. I trade options and obviously forex right now. My claim to fame is that I made my first million at the age of 26. At the age of 33, I was well, more or less financially free. I made enough from my passive income through trading and investing to cover my expenses. So it felt really good till I got really bored, you know. So for the last 12 years, I've actually found my passion in teaching, both live in Singapore as well as now online all around the world, teaching people how to become better traders and better money managers. So again, I hope that what I'm sharing with you today will add more value to you in your trading journey. All right, so to begin, I'm going to be talking about what does it take to become a profitable trader, specifically a forex trader, but it applies to any kind of trading, right? And there are essentially three qualities that you got to have. Number one, to succeed in trading, you got to have a trading system with a positive profit expectancy. And what does that mean, right? Basically, a trading system is a specific set of entry and exit rules based on a sound methodology that gives you a statistical edge in the markets. I know that's a mouthful, but what it means is that you must have that means you must only buy and sell under specific conditions that have been mathematically proven such that the odds are in your favor. The odds are stacked in your favor. So for example, you only buy a currency pair on a strong uptrend, and you buy, for example, at a strong level of support where you have got a bullish candlestick reversal pattern, for example, and you sell only on a strong downtrend at a level of resistance when you've got a bearish candlestick pattern, for example, and you place your stop loss below the support levels or above the resistance levels, so it is difficult to hit those stop losses. And if you do that consistently, you know that you can't win all the time, right? We can't predict the future of any one trade outcome. But if you do that consistently, buying on uptrends, selling on downtrends, buying at support, selling at resistance, what's going to happen? That's right. You're going to win more than you lose. And your average losses are going to be more than your average wins. And over a large sample of trades, you will always be profitable. I guarantee that. In fact, mathematics guarantees that. So in other words, to be a profitable trader, it's not about being right all the time. It's not about being able to predict the future better than another trader. It's about being right more than you're wrong, and winning more when you're right and losing less when you're wrong. And that sounds like a lot of common sense, right? But the reality is that the majority of traders do not have a proven trading system. Or they may have learned a few strategies, but they jump from strategy to strategy and they don't stick to one consistently. And most losing traders, they trade based on listening to the opinions of other people. So they go into a chat room, this guy's buying the dollar yen, he seems smart, you buy the dollar yen, all right? Or they hear that George Soros is shorting the pound, they short the pound, right? Or they trade based on emotions. They wake up in the morning and they say, I feel the dollar's oversold, let's go buy the dollar, all right? Or yen's overbought. And they make predictions, like they say, oh, the Fed's gonna cut interest rates, the dollar's gonna be weak, so let's short the dollar by going long the euro USD, right? And they do stuff like that. And if you do that, what's going to happen, right? Yeah, you're going to make money sometimes, but it's going to be luck, all right? And luck doesn't last forever. And eventually, it's going to even off where you're just entering the market randomly. And if you, like most people, do not have a defined exit plan, a defined stop loss, and a defined profit target, what's going to happen? That's right. Emotions are going to cause you to hold on to losers longer. It's inevitable. It's emotions. No one likes to lose, right? And the instant gratification causes you to take profits too quickly. So in the long run, even though you're right half the time, you lose more when you're wrong, you make less when you're right, and you always lose money in the long run. Okay, so and that's why most people lose money, right? So we know that less than 10% of traders are consistently profitable. Why? Because again, number one, they use and stick to a proven trading system that puts the odds in their favor. And that's the key to it, right? So some of you would ask this question, how do I find or create a trading system that's proven to work, all right? Now, if you attend courses, you read books, you go on chat rooms, you know that traders from all around the world use hundreds of different trading systems. There are so many strategies out there, you can get lost in them, okay? But all these strategies, I find that you can divide them into two major categories. You either have a trend trading system known as a trend continuation strategy, or a counter trend strategy, or also known as a reversal or mean reversion strategy. It's either this or this, right? So trend trading basically means you trade with the trend, all right? You buy on uptrends, you sell on downtrends, okay? Now, I love trend trading. I'm more of a trend trader, okay? But again, there are some people out there who don't do that. They are counter trend traders. They buy on downtrends, right? And there's nothing wrong with that, because they find that on a downtrend, when the price is, for example, oversold, and they see some kind of divergence, like a bullish divergence pattern, or they use an oscillator, right? Like RSI, stochastics oversold, they buy and they hope to catch the reversal, right? They want to catch bottoms and tops. At the same time, they sell on uptrends, hoping that they catch a reversal. Again, when it's overbought, RSI is overbought, stochastics is overbought, they see a divergence, they sell. All right, so again, you've got two different styles, and people always like to ask, what's the best strategy? What's the best style? I've got news for you. There's no best style. There's no best strategy. All right. Okay. Both strategies can give you an edge in the markets because they exploit repeatable patterns. All right. It's like, it's like someone asking me, Adam, what's better, swimming or skiing, snow skiing, right? And it depends on your style, depends on your personality, right? So I tend to prefer trading with the trend, right? Let's call this skiing, right? And I don't like reversals that often, which let's call them swimming, because I find it more difficult, right? So again, two different styles. Now, what's really important is once you decide on your style, you only trade when the market is in sync with your strategy. I repeat that. You only trade your strategy when the market is in sync with your strategy. Now, every day when I wake up, before I start trading, I look at the markets and I want to know what phase is the market in, right? Markets go through phases, kind of like the weather, right? The weather has got, summer, it's got winter, for example, right? So whenever the market's in a consolidating phase, we call it a choppy phase. Let's call this summer, all right? Now you notice that when the market's in a choppy phase, what happens? The moving averages are kind of like crisscrossing each other. They go up and down, and the candles do not respect the moving averages, all right? And that is what we call a choppy phase. But in a choppy phase, you can see clearly horizontal support and resistance levels. Now, during the choppy phase, or let's call it summer, right? What's the best strategy to trade in a choppy phase? And the answer is to trade reversals, to trade counter trend strategies. These are the best times to trade counter trend, because when it's oversold, what do? That's right, you buy and it goes up and you make money. When it's overbought, you short, it goes down, you make money, and you think you're a genius, right? Why? Because your strategy is in sync with the market phase. But is the market always like that? No, it isn't, right? So there are times when the market will go through a trending phase. All right, let's call this winter, right? So as I mentioned before, I'm a trend follower. I love skiing. I don't like swimming, right? So whenever the market is in this phase, what do? I stay out of the markets, okay? The common mistake that a lot of newbie traders make is that they learn a strategy and they try to trade that strategy every day. And it doesn't work because there are certain days or certain weeks where the market's not in sync with your strategies. You go through a losing streak. You keep getting stopped out, right? So over the years, I realized that when the market's choppy like that, when a certain currency is choppy, you don't trade the trend, right? It's kind of like in summer, you don't go snow skiing, you will sink. There's no snow, right? Because when you trade the trend, what's going to happen, right? You see, hey, it's an uptrend, you buy, pump, you get stopped out. Hey, it's a downtrend, you short, pump, you get stopped out, right? You get stopped out because it's not in sync with your strategy. So I only trade when the market is in a very trending phase. And how do you know it's a trending phase? Really simple. Notice that the moving averages are sloping up on an uptrend and sloping down on a downtrend. It's a very clear slope. So hence you go skiing, right? And in a trending phase, notice that the price tends to respect the moving average. The moving average acts as a dynamic support level during an uptrending phase and acts as a dynamic resistance on a downtrending phase. So whenever you see this phase in the market, this pattern, that's when you trade the trend. All right. So that's the first thing I want to understand. I hope it's a useful concept. And I learned something from a guru that said this: in trading, not doing something is doing something. People always think that I got to keep doing something every day. I got to find a trade. I got to trade. And some people, they look at the markets the whole day, and if they don't take a trade, they feel that they wasted their time. You can't think that way. All right. I can tell you that I'm a trend trader, and there are certain days or 2 or 3 days in a row, I don't take a single trade. Why? Because the market's choppy. I know that there's no use taking a trade. Okay, because when I trade, when the market is not in sync, I keep getting stopped out. So those are times I go fishing, I go do something else. Right? Now, similarly, when the market's in a strong trend like that, do you want to be trading reversals? No, right? Because imagine it goes up and you see, hey, it's overbought on the RSI oscillator. It's a bearish divergence, and you short. What happens? It goes down and pump, you get stopped out, right? Or it goes all the way down, RSI is oversold, bullish divergence, you go short, or rather, sorry, you go long because it's oversold. You want to catch the bounce going up, goes up a bit and goes down, right? It's kind of like you're attempting to swim when it's winter. You're going to freeze your ass off to death, right? So you got to know when to trade your strategy. Make sense? Okay. So because I'm a trend trader, let me share with you more about how my strategy works. But again, only use it in a trending market. Only use it when the market's in a winter phase. Got it? All right, awesome. Okay, so let me talk a bit about my trend trading strategy. Now, again, when you trade the trend, there are 2 ways to enter a trend. Either you enter on a retracement or you enter on a breakout. Again, 2 different styles. I prefer to enter on a retracement, but I've got students of mine who do really well on breakouts. Okay, so let's talk about the retracement entry. So first of all, you have to identify, how do you know it's a strong trend? So on an uptrend, a lot of you would know this, right? How do you define an uptrend? It's defined as a series of higher highs and higher lows. Basic kindergarten stuff, right? So it goes this way: impulsive wave, corrective wave, impulsive wave, corrective wave, impulsive wave, corrective wave, and the pattern continues. So we know that on an uptrend, prices still fall, but every time it falls, it makes a higher high than the previous high. Every time it falls, it makes an even higher high than the previous high. At the same time, every time it falls, it makes a low higher than the previous low, low higher than the previous low. So an uptrend is defined as a pattern of higher highs and higher lows, and that pattern continues until the trend ends. Okay, now besides that, on a strong uptrend, you always notice that the moving averages are always sloping upwards, with the smallest moving average above the bigger moving averages. Again, it doesn't matter what moving average you use. Different traders have their favorite moving averages, right? So for example, mine could be 6, 18, and 50, and it's always arranged in that sequence. Make sense? All right. So on an uptrend, when do you enter? You always want to enter at the end of the corrective wave. right? This is called the impulsive wave going up and the corrective wave coming down. It's kind of like a breathing pattern, right? This is like breathing out. You breathe out. Now you can't breathe out forever. You're gonna run out of air, right? Eventually, you gotta breathe in and breathe out again. Breathe in, breathe out, breathe in, breathe out. So you always want to enter at the end of the breathing in, just before it breathes out, right? So breathes in, as it's breathing out, you enter right as it's gonna breathe out, okay? And you could again exit there at the end of the breathing out. That's a quick swing trade that you could take. Make sense? All right. So taking a look over here, again, we enter on the retracement. And again, how would you know it's the end of the corrective wave and the beginning of the new impulsive wave? How would you know, right? So we use technical analysis, right? So there are two things I look at. Number one, I have to see that the corrective wave hits a level of support. Again, it could be a moving average as a support or a trend line. And I want to see a bullish candlestick pattern, like a bullish engulfing, a bullish pin bar, some indication that the price action is reversing up and continuing the trend. So we buy over there and we take profit somewhere over there before the next corrective wave. Got it? All right. Now, opposite, downtrend. So again, downtrend, impulsive wave going down, breathing out, breathe in, breathe out, breathe in, breathe out, and the pattern continues. So on an uptrend, we buy. We go long the currency pair. On a downtrend, we always want to sell. You always trade with the trend. Okay? So again, when's the best time to sell on the downtrend? You always want to sell, again, towards the end of the corrective wave, breathing in, and you sell right as it's going to breathe out at the impulsive wave. So again, how would you know that is the end of the corrective wave, start of the impulsive wave, right? So I look for, again, the price hitting a level of resistance, okay? And I want to see some kind of bearish candlestick pattern, like a bearish engulfing, bearish pin bar, boom, get in the trade, and we exit towards the end of the impulsive wave. And again, on a downtrend is the opposite, right? You see a pattern of lower lows and lower highs. And you always notice that on a clear downtrend, the moving averages are again arranged in sequence, but this time it's arranged from the biggest on top to the smallest below. So it's 50 moving average, for example, over here, 50, 18, and 6 moving averages. And the MAs are all sloping down, all right? So I know for you guys who are more experienced, this is basic stuff, this is kindergarten stuff, but for those of you who are beginners, I hope that gives you a bit of idea of how you identify a strong trend and how you enter on a retracement. So let's look at a few chart examples, right? So over here, we have got the New Zealand dollar. And again, this applies on any time frame, whether you're trading M15, H1, H4, daily, all time frames, right? I personally do not trade anything below M15 because I find that M5, M1 is a bit too choppy and the trends are not as stable as the higher time frames. So at least M15 for me. Now this is a H1 chart, right? So again, you can see a very clear uptrend. How do you know it's a clear uptrend? Again, you see the pattern of higher highs and a pattern of higher lows. So you got to see that price action. Next, the moving averages are all sloping up, right? And you have got the smallest moving average on top and the biggest below. So you've got a 6 moving average, the red is the 6, the 18, the 50, and the 200 moving average. There we go. Okay, so where do I enter? I enter when it corrects to the moving average as a support. Now again, notice that on a clear uptrend, the currency tends to find support at one of the moving averages. And each currency has a different character at a different point in time. For example, there are times when the New Zealand dollar will find support at the blue 18 EMA. There are times you'll find support at the thicker blue 50 EMA. So you must always know at that moment in time, which is the support that's being respected by the currency pair, which is the moving average that's being respected. Okay, so in this case, you can see clearly that this currency pair is respecting the 18 moving average. So where do I enter? Well, this could be an entry point over here. Why? Because it makes a correction over here and it forms a bullish candlestick pattern. This is a bullish pin bar. So the moment I got a bullish pin bar appearing at a support level, I can go long. So I could put a buy order a few pips above the high of the candle. That could be a buy stop order, for example, and my stop loss could be a few pips below the candle, like a stop loss over there. And the difference from the buy price to the stop loss, I call that 1R. R represents a unit of risk. So again, 1R could be, in some cases, 10 pips, in some cases, 20 pips, in some cases, 50 pips, depending on that day, the ATR of the currency pair. The other thing you have to know very well is ATR, or the average true range. The ATR tells you the average volatility of that currency pair. All right, so in this case, 1R could be, I don't know, for example, like 20 pips, okay? So if you're risking 20 pips, you wanna make at least 30 to 40 pips. You always wanna risk 1R to make 1.5 or 2R, all right? So your profit target could be somewhere here, for example, TP over there, where if you're risking, 20, you could be targeting a 30 TP over there. All right, so risking 20 pips to make 30 pips, for example. One is there, you take profit, you're out of the trade, you go for the next trade, right? Here's another example over here. So in this case, dollar yen H1, again, clear uptrend, higher highs, higher lows, moving averages sloping up, moving averages in sequence, all right? And you enter again on a retracement when it hits one of the moving averages that are being respected. In this case, you can see the 50 moving average is being respected. Now, does this always happen? No, it doesn't. So I only trade when a moving average is being respected. Very, very important, right? So in this case, 50 is being respected, right? It retraces and boom, this is a bullish engulfing pattern, as you can see over there, all right? So once I've got a bullish candlestick pattern, again, well, I could put my buy order over there, right above the high of the pattern, a stop loss right below the low of the pattern. Okay, and again, this would be my 1R, which again could be, whatever, could be 10 pips, 20 pips, 30 pips. Now, one of my rules is this: my stop loss distance should always be at least 1.5 ATR of that currency pair. All right, 1.5 times the average true range, because if you put a stop loss less than 1.5 ATR, you will tend to get stopped out very easily. But again, if your stop loss is too far away, then it's going to take a really long time to hit at least 1.5 or 2R, all right? So that's on the long side, right? So on the short side, let's take a look. So this is a clear downtrend. Again, how do you know? Lower highs, lower lows. Look at the pattern. Moving averages sloping down. And again, it's moving averages arranged in the opposite sequence, right? The 200s on top, the 50s below, the 18s over there, and the 6s over there. Okay, so again, we take an entry when the price corrects to the moving average being respected. In this case, which is being respected? That's right, the 18 EMA is clearly being respected. Can you see that? Right, so goes down, retraces, goes down, retraces, boom, we've got a bearish engulfing pattern. We've got our bearish candlestick pattern, boom, we can put our sell stop order over there, and we can put our stop loss over there. And again, this is great because your stop loss is above the 50 moving average and above the 18 moving average. Or rather, sorry, in this case, it's above the 50 moving average. So you always want to place your stop loss above a resistance level so it can't get hit that easily. And vice versa with a long trade. And again, this could be, could be 10 pips, could be 30 pips, depending on the ATR. So at least 1.5 ATR, we are risking 1R. And we want to take profit at least 1.5. Or if you're more aggressive on that day, the market's really strong, take profit at 2R. All right, so there you go, right? So that's how you trade trend retracements.
Adam, sorry, I'm going to jump in because I have this question. It's actually my question.
Okay.
ATR is usually calculated on a daily basis. in the examples you've just given us, these are hourly basis. How would traders find out what the average true range is on an hourly basis? Do you just simply use the indicator on a small time frame?
Absolutely, right? So for example, if I'm trading the H1, I'll just put in the ATR on the H1, and I just check the most recent ATR. And I just use the default 14 period ATR.
Okay, great. Thank you so much. Okay, go ahead.
No. So obviously, if you're trading on M15, the ATR will be very different than trading on H4, right? So if you on a specific day, if you trade on H4, one ATR on H4 could be 25 pips, all right? And M15, the ATR could be 10 pips. So you use the ATR of the specific time frame which you're trading on. Is that clear? All right, great. Okay, so the other way to trade trends is to trade breakouts. Now, again, this is not really my style, but I've got quite a number of my students who are trading this style, and it can be really profitable as well, right? So first of all, how do you identify a breakout? It has to be first, the currency has to first be facing some kind of strong resistance to break out from, all right? So when you're going long, you want to see a resistance being tested at least 3 times. So test 1, test 2, test 3, at least being tested 3 times, we know there's a strong resistance, and then it breaks out, okay? Now, there are many traders who buy the moment it breaks out. Now, there's nothing wrong with that, but I find that that's a bit risky because the market tends to like to fake you out. It's kind of like sports, right? The market, it's sports like in football, basketball, you get faked out, You think the guy's going for you, but he fakes you out. So I never like to enter on the initial breakout. What I like to do is once it breaks out, let it run for a while. Always wait for the price to come back and retest the resistance, which has now become support. All right, so breakout, retest. After it retests, you need to see a bullish candlestick pattern. Again, it could be a bullish engulfing, a bullish pin bar, some kind of indication that is going to move up, right? And then you go long the moment you've got that bullish candlestick pattern. Now, similarly, when you go short, the price must find a strong support. Test 1, test 2, test 3, breakout. And again, a lot of traders get in there, but they get faked out. The moment it's short, boom, it goes up and they get stopped out. So how do you avoid being faked out is, again, don't enter right on the breakout. Let it break out for a while, let it retrace so that the support becomes tested to be resistant. So it retraces, hits the resistance, and you wait for a bearish candlestick pattern. Again, like a bearish engulfing, bearish pin bar. Once you see that pattern, boom, you can put your stop, or rather, you put your sell stop order to enter below that candle. And your stop loss you can place somewhere above that resistance by about maybe 1 ATR, right? Don't put it just above that resistance because sometimes it can go back and take you out. Always put it at least 1 ATR to give some kind of buffer, all right? Same thing here, right? So you enter long here, you buy over there, right? Don't put your stop loss too close because sometimes it can take you out, right? So, give it about 1 ATR, give it some buffer so that, right, you won't get stopped out that easily, right? So I love to use analogies, right? So this kind of like a prisoner being trapped in a prison, right? He can't get out of the fence, he can't get out. And the moment he breaks out of the fence, don't bet on him just yet because he could get pulled back into the prison, right? Right. So wait for him to get out and he comes back for his last kiss goodbye, kisses his cellmate goodbye, I'm going, boom, and he goes out. All right. So here are a few examples on breakouts. So this is on an M15 time frame. Again, you can trade this on M15, H1, H4, any time frame. So this was clearly resistance, 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 breakout. Okay, and again, I avoid taking the initial breakout because you could get faked out, right? So always wait for it to break out and come back to test that the resistance has become support. So you can see it's being tested as support. wait for a bullish candlestick pattern. In this case, we've got a nice bullish engulfing. You place your buy order a few pips above that. Stop loss, you can put it 1 ATR below the resistance and definitely below that bullish candlestick pattern. And that's your 1R risk, right? So again, you can take profit at 1.5R or take profit at 2R. All right, and take it and go for the next trade. Now, to increase the odds of it breaking out, you always want to ensure that, now remember what I told you earlier, when the market's going slightly sideways, what happens? The moving averages would tend to go sideways and even crisscross each other, like in this case, moving averages are crisscrossing, right? When it breaks out, you always want to ensure that at the breakout, the moving averages must be in sequence from the smallest to the biggest moving average. Again, this is the 6, the 18, and the 50. When it breaks out and the moving averages are not in sequence, in the right sequence, you do not take the trade, because this will ensure that it is a clear uptrend upon the breakout. And again, this is what I talked about. This happens with the ATR, the 14-period ATR on the M15 time frame. So again, that's how you know where to set your stop loss. Another example, this is on dollar yen. Again, you can see test 1, test 2, test 3, test 4, test 5, boom, breakout over there. And again, some people would jump in around the breakout. I say wait for retracement. Now, in this case, you can see that after the breakout, it retraced, but it did not retrace back to the horizontal resistance turn support, right? But it retraced back to the dynamic moving average support, which in this case you can see is the 6 EMA. And you can see the 6 EMA has been proven to be a nice support. All right, so that would also be a valid trade. Retraces, hits the moving average that has been proven to be a dynamic support, bullish engulfing pattern, boom, you're in the moment it exceeds that. Buy over there, and you can put your stop somewhere over there. Again, that's 1 hour, and you take profit at 1.5, 2 hour, depending on how aggressive you want to be. Let's take a short example. So again, over here goes down, right? Test 1, test 2, test 3, test 4, breakout. Again, if you entered over there, boom, you got faked out and you got screwed. So very dangerous to enter right at the first breakout or breakdown. In this case, you wouldn't have taken that trade, right? So breakout again, wait for it to retrace to the previous support turn resistance or retrace to a dynamic moving average. In this case, you can see once again, it retraces to the 6 EMA. And the 6 EMA is acting as a dynamic resistance, hits the 6, finds resistance, you got a bearish engulfing pattern, really big engulfing pattern. And again, you could actually take your entry over there, your sell, stop loss over there. That's a very big 1 hour. Now, in some of these cases, if the 1 hour is really big, I may not take the trade, because I find that, you know what, it's just too big a 1 hour, right? So it's going to be really hard hitting 1.5 or 2 hour. But if I think that it's really strong trend, I may still take it and exit at maybe 1.3 hour sometimes, right? So I'm not always a stickler for it has to be 1 to 2. It has to be 1 to 1.5. If I find that it's been overextended in this case, I'm not going to be too greedy. As long as my average win is more than my average loss, I know I'm going to be profitable over a large sample of trades. In other words, I could risk 1 hour to make 1.3 hour, and it's fine, as long as you take profit more than 1 hour. That's my philosophy. Okay, so simple as that, right? So again, trade trends, trade retracements, trade breakouts, you do that and you're going to have a positive expectancy in your trading. Now, here's the thing. Is it that simple? Okay, I've got news for you. It is not that simple. Right? Why? The reason is very simple, because if it was that simple, then everyone who studies technical analysis, who takes a trading course, reads a trading book on technical analysis, would be profitable. But that's not always the case. In fact, there are many newbies who learn the same stuff I taught you. They learn about moving averages, candlestick patterns, they learn about trends, and they find that, hey, there's an uptrend, a retracement, I go long. The moment they go long, what happens? It reverses and they're stopped out, all right? Or they say, hey, the currency broke above a resistance, a breakout, it's a bullish candlestick pattern, they go long. The moment they go in, what happens? Reverses, they get stopped out. And that can be really frustrating. And you're thinking, what's wrong? What am I missing, right? I don't know how many of you experienced that, but I did very often when I first started. And let me give you an example, right? So a newbie would say, okay, I see an uptrend over there, higher highs, higher lows, just like the guy said. Okay, I see a moving average over there. It retraces, boom, I've got my bullish candlestick pattern. I buy and it goes up a bit and pam, I get stopped out. All right. Or again, they see price is finding resistance really strong, breaks out, retest, bullish candlestick pattern, I buy, goes up a bit and I get stopped out. And they think, damn, I must be just really unlucky, right? What am I missing? What's wrong? Okay, and I can tell you that after a lot of after experiencing that a lot myself, I realized the answer is this, right? That trading technical analysis by itself, trading moving averages, candlestick patterns, and trends are not good enough if you want to have a high level of profitability. Okay, I found that besides the TA, you have to also ensure that you only enter when the currency is strong. You only buy the strong currency and you sell the weak currency. Okay, so how do you identify which is the strong currency and which is the weak currency? We use the currency strength meter. Okay, now this is not something that I invented, right? In fact, what I learned is that a lot of the top bank traders that trade for banks, they use a currency strength meter. And there are a couple of them in the market, right? But this one I'm using is my own proprietary indicator that was developed by my team of researchers over the years. And we found it to be really, really powerful. It's kind of like my secret weapon, my secret recipe, okay? And this currency strength meter helps me to identify the strongest currencies versus the weakest currencies. And let me explain how it works using my MT4 over here. Now, right now the market's closed. Usually I like to demonstrate this when the market's open and it's live, but now it's a Sunday, it's closed. So I'll do my best to explain. And I also play you a short recording of when the market was live a couple of days ago. So you can actually watch it live, right? Okay. So over here, this is the currency strength meter, and the currencies are numbered from 1 to 100, right? So any currency that is 60 and above is a strong currency relative to the other currencies. And above 60 is coded in green, as you can see. These are the green currencies. Currencies that have a value less than 40 are weak currencies, and they are coded in red. And the ones in yellow are between 40 to 60. These are the ones that I prefer to avoid because it is neither strong nor weak. I always want to buy the strong currencies, the ones in green, and simultaneously sell the weak currencies, the ones in red. And that will give me the strongest edge in the markets. Now you can see that it could be a currency pair could be strong on one time frame and weak on another time frame. So it depends on what's the time frame you're trading on. Okay, now this is what I do. Again, I tend to trade on the M15 and H1 and H4 time frames, depending on where I find a setup. Okay, now how do I start? I always start by looking at the higher time frame. So for example, if I want to trade on H1, I will look at H4 to see which are the strong and weak currencies to trade. All right. Now, this is actually Friday's chart, just before the market closed. In fact, I just took a trade just before the market closed. So I'm going to show it to you right now what I did, right? So on Friday, it so happened on H4, which was the weakest currency? The pound, right? Pound is only 9 and it's red. And the strongest currency was the yen. which was 66, green. Okay, so I want to sell the pound and I want to buy the yen, right? You always match the strongest with the weakest. Okay, so in other words, I want to be selling the pound yen. Now you can't simply just go sell the pound yen. You got to see a setup, right? So what I then do is I then go to my charts, and again, this was Friday. I went to my charts on the pound yen, again on the H1 time frame, and sure enough, I saw a setup, which was a support, 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 breakout. There we go. And again, I did not enter on the breakout. I waited for a bit of a retracement, right? So in this case, it went down quite a bit. And over here, I had a mini retracement. It retraced not to the previous support and resistance, but like I mentioned, in this case, it retraced to the dynamic resistance of the 6 EMA. And it formed a very nice bearish candlestick pattern. This is a bearish pin bar, right? Now, it doesn't matter that the pin bar is green, it's still called a bearish pin bar because it's got a long upper shadow and a small lower shadow. So the moment I saw that, I went to sell the pound yen, right? I placed a sell order there, and I placed my profit target somewhere over there. Sorry, my stop loss somewhere over there, ensuring that I had at least 1.5 ATR in terms of my stop loss distance, right? Now, I did not allow the trade to hit my profit target. Why? Because one of my rules is I never hold my trade over the weekend. It is very, very dangerous because over the weekend, if Boris Johnson says something stupid or something smart, okay, guess what? That's right. On Monday, the currency could get up or get down strongly. And if it gets against you, you could really get screwed because instead of losing 1 hour, you could lose 4 to 5 hours. So my rule is before I go to sleep at night, on a weekend, I always close my position. So because of that, I did not, I did not allow it to run its full course, and hence you can see that it's just a very, very small profit that I got over there. This was on Friday. This was a pound yen. It was a small position and just a small profit over there. That's it, right? And so on Monday, when I wake up, I'll then do the same thing again, right? So essentially, that's how I use the currency strength meter. Okay. Now, like I said, usually I like to demonstrate this live, but right now it's market's closed. So I thought what I'll do is I'll play you a short 5-minute or 4-minute recording of when the market was live a couple of days ago, showing you how I look for trades using the strength meter. So let me just play this like 4 to 5 minute recording, which I just did. Okay, so this is how it works basically. Now you can see from the table right here. Now, if we look at the 4-hour time frame, we can see what are the strong currencies. The dollar is green, right? So it's strong. The euro is strong. The franc is strong, and the yen is strong on the H4 time frame. Now, what's weak? What's weak would be the pound, right? The Aussie and the New Zealand dollar. So how do I know which pairs to look at to look for? Okay, so what could I match? Now you can see that euro is really strong. Euro is green across all time frames. So I definitely want to be looking at the euro right now, right? So euro is strong. And what's really weak? What's really weak is the New Zealand, right? So euro, New Zealand. This is all green, that's all red. I love that, right? So euro, New Zealand. So obviously, I like to be buying the euro because it's a green and selling the New Zealand, which is red. So looking at the euro New Zealand pair. So if I go and look at the euro New Zealand pair, all right, so I'm at the euro New Zealand pair, and sure enough, you can see euro New Zealand. Now, notice I was looking at it from the H4 time frame. but I always take a trade on the lower time frame. In this case, I'm looking at the H1 time frame. And again, you can see on the H1 time frame, Euro New Zealand is on a pretty clear uptrend with the moving averages sloping upwards in sequence, all right? And it's making higher highs and higher lows. And so what am I waiting for? That's right, I'm waiting for it to retrace down, right? So you can see that the 50 seems to be a strong level of support over here. So it retraces down. If it hits the 50 moving average as a support level, I've got a bullish candlestick pattern, right? That will give me more confidence in action. I could then look at taking the trade, entering here, and then taking the trade to take profit somewhere there. So again, I'll be looking at this pair right now because again, Euro is the strongest currencies, New Zealand is the weakest currencies. So what are other combinations that I would trade, that I would focus on for today, right? So Euro New Zealand, I could also look at, for example, the Aussie versus the franc, right? So again, Aussie is red, so Aussie is really weak today, right? Franc is strong on most time frames except the 15-minute, that's fine, right? So I look at Aussie franc. So let's take a look at Aussie franc right now. Where's my Aussie franc? There we go, that's the Aussie franc, okay? And again, Aussie is weak, so we're gonna sell the Aussie. Franc is green, we wanna buy the franc. Okay, so sell Aussie, buy franc, which means we're gonna short the Aussie franc pair. And sure enough, you can see the Aussie franc pair is in a very, very strong downtrend. And you can see recently it was fighting support and it broke the support over there and going all the way down. Like I said, whenever the currency strength is aligned to the trend continues all the way down very, very strongly. Very strongly in the event of Euro New Zealand. Now, what you do not want to do is you do not ever want to trade two currencies that are strong or weak at the same time. For example, it'd be really stupid to trade the Euro yen, for example. Now, why won't you want to trade the Euro yen? Because Euro is green and franc is green. They're both strong currencies, right? So whether you buy the Euro yen or you short the Euro yen, it's not going to go clearly in one direction because two strong currencies are fighting against each other, right? At the same time, you'll also be very stupid to trade the pound Aussie or the pound New Zealand because they are both red currencies, so they are both weak currencies. So again, if you trade that pair, it's not going to go very clearly in one direction. They're both weak. So again, always buy the green and sell the reds. And do it when you see a retracement on the trend or breakout from the consolidation. When you combine this, it becomes a very, very powerful strategy to achieve high returns of profit and win rates in your trading. All right, so I hope that was a useful explanation on how I use the currency strength meter, or quite CSM, on a daily basis to look for high probability trades. And you can see just how powerful it is to combine the CSM with a technical setup, right? These are screenshots I took from my Telegram live community chat groups, where I trade live with my students every single day, right? So like this guy, Norbert, I think he's from the Philippines. He said 8 hours today focusing on BFS trades. What's BFS? Bull flag surfing setups. And I'm going to teach you that strategy in a short while, so hang on, right? On Aussie franc, New Zealand franc. Thanks, Adam, for giving us a CSM. Helped me a lot to focus on pairs with the strongest trends. And this guy, Aaron, I think he's from Singapore, says CSM is a useful tool. I had 4-hour win today, all right? And Adam, I'm on a 9-trade winning streak using CSM, strictly taking the strongest currencies against the weakest. This is Dale from the UK, right? So very, very powerful when you combine the two, right? This is our own take profit logo sticker that we use. First trading day of the month, this was back in June. And again, we call out trades to each other. So in this particular day, I called out a trade and my traders were like thanking me. Thanks, Adam, congrats. Thanks for the call. Thanks for the call. Thank you, TP. Thanks for the call. So we help each other to spot trades every single day, right? You can see on one day achieving 3.5 R, all right, 5.5 R, 6.7 R, 5.2 R, 5.4 R, 6.5 R. That's Jamie from the US. Okay. After Adam's FX class and videos, just took 3 trades this week on bull flag, surfing, trend continuation entry, and all of them hit my target profit. Many thanks over here, right? So it's a very, very powerful combination, right? So a lot of my students were talking about BFS, right? So what's BFS? It's one of the strategies that I can share with you today. Is known as the bull flag surfing setup, okay? So what are the entry and exit rules, okay? Now again, why do we call it bull flag surfing? It's a strategy which we trade when we notice that a currency pair is surfing on one of the EMAs. In this case, you can see that it is surfing on the 6th EMA, right? It's kind of like, it's kind of like gliding and surfing off the EMA. Now again, does this always happen? It doesn't always happen. So you got to be patient to spot this pattern when it appears. So here are the specific entry rules. First, you want to make sure that the currency strength is aligned. In this case, I'm buying the Aussie yen. So Aussie must be green, yen must be red, right? Moving averages must be sloping upwards. Candles are surfing the EMA. Now, what is the entry setup? First, I look for a strong impulsive wave. Like this green candle is a strong impulsive wave up. Then I look for a series of corrective candles making lower highs. So from this impulsive wave, we have got lower high, lower high, lower high, lower high. It has to make lower highs all the way. If you see a higher high, it is invalid. It has to make lower highs all the way until it hits the dynamic moving average, which it is surfing on. In this case, the 6 EMA. The moment it hits there, I'll place a buy order just above the high of that last candle, stop loss just below the low of that candle. And again, I want to make sure that the 1 hour distance, in this case it is 8 pips, is at least 1.5 ATR of that time frame, in this case M15. And I set my profit target at 2R in this case, right? So I'm risking 8 pips to make 16 pips in this particular case, right? And what's my exit rule? Very simple. It either hits my stop loss or it hits my profit target, either one. So to me, it's a binary outcome, either hit stop loss or hit the profit target. All right, so this is a very simple strategy that you can see my students are making a killing with in the markets every single day. All right, so far I've talked about only 1 out of 3 things that you need to have. You gotta have a trading system, right? But number 2, very quickly, let me talk about position sizing. Now again, you can learn the best trading system from the best trader out there and still not make consistent profits because you did not size your positions correctly. So what is position sizing? It is what tells you how many lots to trade, long or short. Now here's the thing. The key to consistent profitability is to always trade a consistent risk of your capital, okay? Now, the trouble with a lot of people is that they adjust their risk based on their feelings, right? When they feel confident, they say, okay, I'm going to trade 5% of my capital on this trade. And I'm not so confident, I'm going to risk 1%. You can't do that. You can't do that. You know why? Because every trade outcome is random. You've got no idea which one's going to be the winning trade and which one is going to be the losing trade. And here's the problem. When do people get confident? People tend to get confident after a winning streak, right? So they've got 4 wins, they get confident, they start to increase their risk, and that's precisely when the losing trade will come. So one losing trade will wipe out all their winning trades. Now, conversely, when people have 4 losers in a row, what happens? They get scared, they lower their risk, right? And the moment they lower their risk and the winning streak comes, what happens? That's why the wins can't cover the losses because they just risk less. So you gotta you got to always maintain a consistent risk per trade of 1% to a maximum of 3% of your capital. Now, you may say, hey, why do you only risk 3%? Why do you risk 10%? Because I don't care how good a trader you are, we will all go through losing streaks of sometimes 4, 5, or even 6 losing trades in a row. It can happen. It may not happen today, next week, next month, but it will happen one day. And if you risk too much, it will wipe out your capital. So the key is to always preserve your capital in the event of a losing streak when it comes one day. All right. So how do you calculate the number of lots to trade? This is the formula, right? The number of lots to trade is equal to your current capital multiplied by your risk per trade, that must be consistent, divided by the stop loss distance multiplied by the dollar value per pip per standard lot. Now you don't have to do this manually. It's all done using forex position sizing calculators they can get online anywhere for free, right? So it's all there, but I need to understand the concept, right? So for example, you got 5 grand in your account right now. You decide to risk 3%. What's 3% of 5 grand? It is $150, right? Which means that the worst that can happen is you lose $150. You then divide the $150 by the stop loss distance, which is the 1 hour distance. So again, depending on the setup, could be 10 pips, could be 50 pips, depending on the ATR. Then you multiply by the dollar value of the pip on that day, okay? So in this case, a loss would mean you lose 1 hour, which is 150. And if you win at least 1.5 hour, which would be 225 in this case. So how would we apply that to that previous strategy which I talked about, the bull flag, right? So in this case, let's imagine your capital is 3 grand. You decide to risk 2%, right? And again, this has to be consistent throughout all your trades. How many lots do you trade? 3 grand times 2%. That is $60 in risk. Again, the worst that can happen is you lose $60, all right? And you divide it by, recall the stop loss distance. In this case, the stop loss distance is 8 pips for this example. So 8 pips times the dollar value per pip per standard lot. So in this case, you trade 0.75 lots. So if it's a losing trade, you lose $60. If it's a winning trade, you win double your loss, which you win 120, right? Now, what happens if you do this consistently? You create a powerful trading business plan. So in your business plan, you always have a fixed TP and SL and entry price. So the chance of hitting the profit target, again, you can't be right all the time, right? But if you can be right 50 to 60% of the time over a large sample of trades, you're good to go. Now, there are days and weeks I have an 80 to 90% win rate, but I know it will not happen all the time. There'll be times when your win rate could even drop below 50%. Doesn't matter, as long as in the long run, you are right slightly more than half, and you are wrong slightly more than half. But the key is when you're wrong, you lose 1 hour. When you're right, you make 1.5 hour to even 2 hour at certain times. And each time when you trade, you risk 1% to 3%, which means you win 1.5 to 4.5%. Okay, so very quickly, let's take a look at what happens. If you do 20 trades a month, for example, at a 60% win rate, that's 8 losses and 12 wins. And assuming you risk 2% of your capital, you lose 16%, but each time you win 3% if you're risking 1 to make 1.5. So each time you win 3%, that's 36%. That gives you 16% return a month. Now, I know to some of you may not seem exciting. Say, Adam, I want to get 100% return a month, 200% return a day. Yeah, I know there are people out there who can do that, right? I'm not one of them, okay? Because I know a lot of people who make 200% a day, but they're not around the next day. I'd rather make a small return, but being consistent. So you've got a consistent stream of income where trading is not a sprint, it's a marathon, all right? So, it's better to make small, but make consistent. Now, what if your win rate drops to 55%? Well, that's 9 losses and 11 wins. Again, if you're risking 2% to make 3%, that's 15% return a month. If you compound that, that's a pretty good return a year, right? So think in the long run, think statistically, right? If your win rate drops to 50%, which is random, right? You lose 10, you win 10, but again, because you have the discipline to stick to your 1 hour loss and 1.5 hour win, what happens? That's right, you're still pulling out 10% a month, right? And so that's how I train myself and my community of traders for the last 12 years. And that's why I've got students who share with me their results, like this guy, his name is Eli Sabayev. I hope I pronounced it correctly. I don't know where he's from, I forgot. So just want to share with you guys, since March to now, in 2 months, I managed to accumulate a total of 26% return on my initial amount. Finally, my performance turned upward direction. When I finally have a positive return, it feels like all the previous years of pain has paid off, right? So you can do it too, no matter how bad it's been in the past. This guy's from Myanmar. His name is Alex. He said, I've tried many trading systems, both free and paid. I was not getting consistent results. 3 months ago, I started learning and applying Adam's strategies. My first month wasn't profitable, but I learned a lot of new things and had a great time interacting. In my second month, I made 7.6 R. In my third month, I made 10 R, and he's only getting better, right? And again, this guy's from Norway, Oystein, and recently he just sent me his records as well. He did about 30% gain since March of this year. All right. This Michael Bradley from the US, you can see again, you can't win all the time, but your average wins are bigger than your average losses. And he managed to get 17.9 R in a month, in his first month of trading the strategy. All right. Now, finally, I know I'm kind of like running out of time. I've taken about an hour, so I'm just going to wrap it up really quickly. The last thing, again, is psychology. I'm sure you've heard that many, many times. And I assign 60% of your success to psychology. It's like you have the best trading system, the best position sizing, but if you don't have the mindset to follow the system consistently without deviation, you can't get the results you want. You can't reach the promised land. It's like people know, logically, I should exercise an hour a day. Logically, I should avoid certain foods. I should take certain foods. I know that, but they don't do that. They don't go to the gym. They don't eat right, and they don't lose weight. All right. So that's the reason why many people learn the trading systems, but are not able to replicate the profits of the winning traders because their emotions come in to screw them up. And that's why a big part of my training is the psychological conditioning of the trader. And that's why we have got this community where we scold each other. We literally scold each other when we don't follow the rules. And that's how we help each other to stay focused, all right? And let me just end off my presentation by saying that, congrats for learning how to trade, because, to me, trading is the only skill that can guarantee you an income for the rest of your life. Nowadays, you can go to the best universities, and you can learn programming, engineering, accounting, marketing, and all these skills can't guarantee us an income 10 years, 5 years from now, because we can get replaced by someone else with the same set of skills, who's younger, cheaper, faster, from a different country, or even be replaced by a robot or AI, right? But when you can trade the financial markets anywhere in the world, you can live, you got a computer, you got an internet, you got a technique, you got a skill, you can create an income for the rest of your life. So I hope that it's something that you stick to, it's something you never give up on, and it's something that you master. Because if you're willing to take 4 years to go to university to get a job and work for someone else, why should you take anything less to master this skill to help you create income for yourself for the rest of your life, right? So with that, I hope you enjoyed my presentation. If you want to find out more, I'll answer some questions right now. In the meantime, you can also go on to piranhaprofits.com, where I teach my professional online trading courses, right? So with that, I'm happy to take questions.
Great.
I think, yeah.
Thank you, Adam. You are my brother from another mother because literally 90% of the information I communicate is similar to yours. And ironically enough, I'm going to show later in the webinar today how I also traded pound yen Friday. A little bit different setup. We have sort of a difference in philosophy of risk and rewards, but literally the same ideas, the same structures. It's just I'm listening to you and I'm laughing at myself at how similar you and I have in terms of the approach of the market. I hope you guys absolutely love this presentation. I certainly did. I put in a link here to Adam's level 1 course. There's a few questions here, Adam, first of all, about how people can join your community. I imagine they can simply go to Piranha website, as you have it up here right now, and probably click the link for the community and the Telegram service. But I'll let you explain how that goes on. Go ahead.
Yeah. So for the professional forex trading course, we have got level 1, which is the basic course, and level 2, which is the advanced course. So in the basic course, I teach you some of my basic trading systems. Plus, of course, you get the currency strength meter. But it's only in the advanced course where I teach the whole range of different strategies. Plus, you get to join our private Telegram chat group only in the advanced course. The reason is very simple, because in a Telegram chat group, we call out trades every day based on all the systems. So if you take the basic course, you learn the basic systems, but there are many of the advanced systems that we call out every day that you won't be familiar with. And that's why you need to take the advanced course to get into the community of traders.
Okay. Yeah. Sounds good. So everybody, please go ahead, take advantage of that. Now, speaking of that, there's just a couple of questions because we're definitely over time, but it doesn't matter. You know, as I said, we ran over time yesterday. I'm going to run over time today because the information here is so valuable and we get a chance so rarely to speak to great traders. So we'll take our time here. So a couple of questions. First of all, the question, Adam, a lot of people had was, do you ever scale in, scale out into your positions? Is it always single entry, single exit?
Yeah, so my style for trading as opposed to investing is, yeah, single entry, single exit. I don't scale out at all. Yeah, I don't scale in, but I do scale out at times. I have got a strategy which I trade where it's kind of like a trend rider strategy, where what I do is once I reach 1 hour in unrealized profit, I would sell half the position, move my stop to entry, and leave the second half to run and exit when it closes above the 12 EMA, which is an indication that the trend is no longer strong. So yeah, so for that particular strategy, there is a bit of scaling out, but I don't scale it, not my style.
Okay. What about the very, very common situation we all find ourselves in, where it goes to like 90% of R, stops, and then reverses? What do you do? What do you do in that case?
There's nothing you can do, right? So in fact, I for most of my strategies that I do and I trade, it's a fire and forget. All right. So I tell my students, you place the trade, your stop is there, your profit target is there, go do something. Don't look at it, right, until it's resolved. Either hit one or the other one, because if you look at it, you're gonna go crazy, right? Because yeah, there are many times where it's gonna almost hit your stop loss, misses by half a pip, and it hits your TP, or the reverse happens, right? Misses your TP by half a pip and hits your stop loss. So half the time you're going to get frustrated, half the time you're going to be lucky, but in the long run, right, you know, it's not about luck. It's about, you know, consistently following the system and letting the edge play out. So don't be concerned with any single trade outcome. You can't control it. Yeah. And it's emotionally draining when you watch it.
Yeah, no doubt about that. Another question that people had was, how many systems simultaneously do you trade? In other words, is there like 3 bread and butter systems? 1, how many different trading systems do you have in place at one time?
Personally, for me, I only trade 2 systems.
Okay. Now,
I only trade primarily 2 systems. Yeah.
Okay. Now the other question I had was, or people had was, how many of, let's say you trade those 2 systems on average, and obviously every week is different, volatility is different, but on average, how many trades do you place every single week?
In a month, roughly about 20 trades, 20 to 25 trades a month. on
20
average?
to 25 trades a month, which really works out to about 1 to 2 trades a day. And obviously, some days you don't trade, so it's sort of like it's a very interesting. And this is off of a 15 to 1 hour chart. So you're really trading relatively short-term time frames, but very, very selective in
Very
your.
selective.
Interesting, really interesting. That surprises me, actually. That really surprises me. Okay. I think, because we have lots of other speakers, and I just want to be kind to them as well. I loved this presentation. I think everybody in the room has gotten very, very positive responses. As I said, all of this is going to be recorded. All of the content that Adam provided for us is going to be PDF'd, so you guys will have access to this. You have the link to his level 1 course. If you want to go to level 2 course, please, I highly encourage you. The concepts he taught you today are gold, absolutely the most valuable, interesting stuff. Even if you sort of never trade any of his systems, these are foundational concepts that anybody who is a professional trader will tell you are incredibly useful to remember. So I hope you guys really enjoyed it. I want to thank you so much from the bottom of my heart for attending. I think everybody really loved it, and everybody enjoy Piranha Profits, and we're going to move on to our second speaker. Thank you so much, Adam, again.
All right, thanks for having me, Boris.